Let me tell you something that goes against everything you have probably heard about my investment philosophy. People think I never sell. They think I buy stocks and hold them forever, no matter what happens. They have heard me say that my favorite holding period is forever, and they have concluded that I simply do not sell. This is dangerously wrong. Yes, I prefer to hold great businesses for decades. I believe that excessive trading destroys wealth, but I am not married to my stocks. When certain things happen, when certain red flags appear, I sell immediately. Not reluctantly, not gradually, immediately. And today, I am going to share with you the 5 red flags that make me reach for the sell button without hesitation. These are the warning signs that have saved me from catastrophic losses throughout my career. They are the signals that tell me a business has fundamentally changed, that the thesis I used to buy no longer applies, that staying invested is no longer rational but has become emotional attachment masquerading as long-term thinking. I want to take you back to 2011 because that year taught me one of the most painful lessons of my investing career. I had owned a significant position in a company for several years. The business looked fine on the surface. Revenue was growing, profits were increasing, the stock price was performing well. But something bothered me. I noticed that the company's accounts receivable were growing faster than revenue. Customers were taking longer to pay their bills. At first, I dismissed it as a temporary issue. Maybe they had extended credit terms to win some large contracts. Maybe there was some industry-wide slowdown in payments. I told myself stories to explain away what the numbers were clearly showing. Then I noticed inventory was building up. The company was producing more than it was selling. Again, I rationalized maybe they were building inventory ahead of expected demand. Maybe there were supply chain issues that made holding extra inventory prudent. I kept holding. 6 months later, the company announced that a significant portion of their accounts receivable was uncollectible. Customers they had been booking as revenue had never intended to pay. The inventory buildup was not strategic preparation. It was product that could not be sold at any price. The stock dropped 40% in a single day. It dropped another 30% over the following months as the full extent of the problems became clear. I lost hundreds of millions of dollars on that investment, not because I could not see the warning signs. The warning signs were there, flashing bright red in the financial statements. I lost because I did not act on what I saw. I rationalized. I hoped. I waited for things to get better instead of acknowledging that things had fundamentally changed. That experience crystallized something I had known intellectually but had not fully internalized emotionally. Selling is not failure. Selling is not admitting you were wrong. Selling is recognizing that circumstances have changed and acting accordingly. The truly costly mistake is not selling when you should. The truly costly mistake is holding on to something that is broken while telling yourself stories about why it will recover. Since that painful lesson, I have developed a clear framework for when to sell. 5 specific red flags that, when I see them, trigger immediate action. Not contemplation, not wait and see. Immediate action because I learned the hard way that when these red flags appear, the situation almost always gets worse before it gets better, and often it never gets better at all. Let me walk you through each of these 5 red flags in detail. I will explain what they look like, why they matter, and how to spot them before they destroy your portfolio. The second red flag that makes me sell immediately is when I discover that management has been dishonest. Not mistaken, not overly optimistic dishonest. There is a crucial difference, and understanding that difference is essential to being a successful investor. Managers make mistakes all the time. They overestimate demand for new products. They underestimate competitive threats. They miss their earnings guidance. These mistakes are part of business. I do not sell because management made a mistake. I have made plenty of mistakes myself. What I cannot tolerate is dishonesty. Let me tell you a story that illustrates this perfectly. In the early 2000s, I owned shares in a company whose CEO was considered one of the most respected executives in America. He was on magazine covers. He gave speeches about corporate governance. He was held up as an example of how to run a public company with integrity. Then I started noticing small inconsistencies in his public statements. He would say one thing on an earnings call and something slightly different in a media interview. The numbers in the annual report did not quite match the numbers in the quarterly reports. Individually, each discrepancy was small enough to be explained away together. They formed a pattern. I sold my entire position. My team thought I was being paranoid. The stock was performing well. The company was growing. The inconsistencies I noticed were minor. They argued maybe I was being too picky. 6 months after I sold, the company announced that they had been manipulating their accounting for years. The CEO I had admired was forced to resign in disgrace. The stock lost 80% of its value. Investors who held on were devastated. I was not a genius for seeing this coming. I simply followed a rule I had learned through painful experience. When you catch someone being dishonest about small things, they are almost certainly being dishonest about big things. And in business, dishonesty about big things eventually gets exposed. Here is how I spot management dishonesty. First, I pay attention to how they talk about problems. Honest managers acknowledge challenges directly. They say, we made a mistake. Here is what went wrong, and here is what we are doing to fix it. The dishonest managers deflect. They blame the economy. They blame competitors. They blame factors beyond their control. They never admit that their own decisions contributed to poor results. Second, I watch for changes in accounting practices. When companies suddenly change how they recognize revenue, how they account for expenses, how they value assets, there is usually a reason. Sometimes the reason is legitimate. Often the reason is that the old accounting was about to reveal something management wanted to hide. Third, I compare what management says to what the financial statements show. If the CEO talks about strong customer demand but accounts receivable are ballooning, someone is not telling the truth. If they talk about operational improvements but profit margins are declining, the words and numbers do not match. And when words and numbers conflict, I trust the numbers. The first red flag, and the one that most reliably predicts disaster, is when a company's competitive position is permanently impaired. This is different from temporary setbacks. Every company faces challenges. Competitors launch new products. Economic conditions fluctuate. Customer preferences shift. These are normal parts of business, and great companies adapt and overcome. What I am talking about is something more fundamental. When the moat that protected a business has been breached, when the competitive advantage that justified the investment no longer exists, that is when I sell immediately. Let me give you an example that cost me dearly because I did not act fast enough. For decades, I owned stock in a newspaper company. I loved the newspaper business because it had what I considered an almost impregnable moat. In most cities, there was only one major newspaper. Advertisers had no choice but to use that newspaper to reach local customers. This monopoly position allowed newspapers to raise advertising rates year after year while maintaining fat profit margins. It was a beautiful business. Then the internet happened. At first, I did not think it was a big deal. People had been predicting the death of newspapers for years, and newspapers kept making money. But gradually, then suddenly, the competitive position was destroyed. Classified advertising, which had been a huge profit center for newspapers, moved to Craigslist and other online platforms. Display advertising moved to Google and Facebook. The monopoly that had made newspapers so valuable evaporated. I held on too long. I kept telling myself that newspapers would adapt, that they would find a way to monetize their content online, that the brand value would translate to the digital world. I was wrong. The competitive position was permanently impaired, and no amount of hope or adaptation could restore it. Here is what I learned from that experience. When evaluating whether a competitive position has been permanently impaired, I ask 3 questions. First, has a new technology or business model emerged that fundamentally changes how customers get the value this company provides? When ride-sharing apps emerged, the competitive position of taxi medallion owners was permanently impaired. When streaming emerged, the competitive position of video rental stores was permanently impaired. When online retail emerged, the competitive position of certain brick-and-mortar retailers was permanently impaired. Second, as a low-cost competitor emerged that can provide similar value at a dramatically lower price, this destroyed the competitive position of many legacy airlines, many traditional retailers, many established brands that had relied on distribution advantages that the internet eliminated. Third, have customer preferences permanently shifted away from what this company offers. This is what happened to many tobacco companies as smoking rates declined, to many soda companies as consumers shifted to healthier beverages, to many fast food chains as tastes changed. When I see a competitive position being permanently impaired, I do not wait to see how management responds. I do not give them time to pivot or adapt. I sell immediately. Because here is the painful truth about impaired competitive positions. They almost never recover. Once the moat is breached, once the advantage is gone, the business becomes a commodity. And commodity businesses are worth far less than advantage businesses. The stock price adjustment, when it comes, is swift and brutal. I want to share another story about competitive impairment because it is so important. In the 1990s, I watched the competitive position of several retail businesses get destroyed by a single company, Walmart. These were regional department stores and discount chains that had served their communities for decades. They had loyal customers, they had good locations, they had experienced management teams, but none of that mattered when Walmart opened a store nearby. Walmart's scale advantages, their distribution system, their purchasing power made it impossible for regional players to compete on price. And when you cannot compete on price in discount retail, you cannot compete at all. One by one, these regional chains were destroyed. Their competitive positions were permanently impaired by a more efficient competitor. The smart investors sold when Walmart announced expansion into their markets. They did not wait to see if the local chain could somehow survive. They recognized that the competitive position was broken and acted immediately. This pattern repeats constantly. Amazon did to many retailers what Walmart did to discount stores. Netflix did to Blockbuster what cable television did to broadcast networks. The specific companies change, but the pattern is consistent. When a superior business model emerges, companies with inferior models face permanent competitive impairment. Hoping they will adapt is usually hoping in vain. The time to sell is when you first recognize the threat, not after the damage has been done. The third red flag that triggers immediate selling is when capital allocation becomes irrational. Let me explain what I mean by this. Because capital allocation is something most investors ignore, but is actually one of the most important factors in long-term returns. Every company generates cash from its operations. What management does with that cash determines whether shareholders get wealthy or get wiped out. Rational capital allocation means investing in high return opportunities when they exist, returning cash to shareholders when they do not, and never overpaying for acquisitions regardless of how exciting they seem. Irrational capital allocation means the opposite: empire building, overpaying for acquisitions to grow revenue, retaining cash that could be returned to shareholders, investing in low-return projects just to look busy. I owned shares in a company for nearly 15 years. It was a wonderful business with strong competitive advantages and excellent returns on capital. Then something changed. The company made a large acquisition at a price that made no sense. They paid 25 times earnings for a business in a declining industry with no obvious synergies. When I analyzed the deal, I could not make the math work under any reasonable assumptions. The company was destroying shareholder value to grow bigger. I asked management about the acquisition during a private meeting. Their answer was revealing. They talked about revenue growth. They talked about market share. They talked about strategic positioning. They never mentioned return on invested capital. They never explained how this acquisition would benefit shareholders, They were building an empire, not creating value. I sold immediately after that meeting. The acquisition turned out exactly as I feared. The acquired business underperformed expectations. Massive write-downs followed. The stock languished for years as the company struggled to digest a bad deal. Meanwhile, shareholders who sold were able to redeploy their capital into better opportunities. Here is how I identify irrational capital allocation. First, I watch the size and price of acquisitions. When companies make acquisitions that are large relative to their existing business and pay premium prices, that is a warning sign. Good acquirers are patient. They wait for reasonable prices. They walk away from deals that do not make sense. Bad acquirers chase deals, pay whatever is necessary to win, and justify overpayment with optimistic projections about synergies and growth. Second, I look at what happens to debt levels and share counts. Companies that consistently increase debt to fund acquisitions are borrowing from the future to flatter the present. Companies that use stock to make acquisitions are diluting existing shareholders. Both are signs that capital is being allocated to benefit management's desire for growth rather than shareholders' desire for returns. Third, I listen to how management talks about capital allocation. Do they discuss return on invested capital? Do they have clear criteria for what return a project or acquisition must achieve? Do they talk about returning cash to shareholders when internal opportunities are insufficient? Or do they only talk about growth, revenue, market share, and strategic positioning? The language management uses reveals their priorities. Let me tell you about another form of irrational capital allocation that is particularly dangerous. It is what I call the vanity project. A CEO decides the company needs to enter a new market or develop a new technology, not because the returns justify it, but because the CEO finds it exciting or prestigious. I have seen technology companies pour billions into media acquisitions because the CEO wanted to rub shoulders with Hollywood celebrities. I have seen industrial companies invest in consumer products because the CEO was bored with their core business. I have seen profitable companies nearly destroy themselves chasing growth in markets they did not understand because management believed bigger was always better. These vanity projects are especially dangerous because they often come from the most charismatic and successful CEOs. The same confidence that built the original business leads them to believe they can succeed in any market. But confidence without competence is just hubris. And hubris destroys shareholder value with remarkable efficiency. When I see a company's capital being directed toward a CEO's pet project rather than the highest return opportunities, I sell the ego that drives vanity projects does not diminish over time. It grows. Today's modest investment in an unrelated business becomes tomorrow's bet the company acquisition. By the time the damage is visible to everyone, it is too late to sell at a reasonable price. The fourth red flag that makes me sell immediately is when I lose confidence in my ability to understand the business. This might sound strange coming from me. I have been investing for over 80 years. I have analyzed thousands of companies. You might think that nothing could confuse me at this point. But the opposite is true. The longer I invest, the more I appreciate how much I do not know. And when I find myself unable to understand the business I own, I sell. Let me tell you about a time this happened. I owned shares in a financial services company that had performed beautifully for years. The business model was simple. They made loans, collected interest, and managed their credit risk carefully. I understood it completely. Then the company started getting into complex derivatives. They started using financial instruments I did not fully understand to hedge risks. I could not fully quantify. When I read the annual report, the footnotes about derivative positions went on for pages and pages of dense technical language. I called the CFO to ask questions. His answers raised more questions than they answered. I realized that I no longer understood how this company made money. I did not know what risks they were taking. I could not evaluate whether the reported profits were real or whether they were accounting artifacts that would eventually reverse. I sold not because I had any specific concern about the company's health, but because I had lost the ability to make an informed judgment. Investing in something you do not understand is not investing. It is gambling. 3 years later, that company nearly collapsed during a financial crisis. The derivatives positions I could not understand blew up spectacularly. The risks I could not quantify turned out to be enormous. Shareholders who held on lost everything. I was not smart for selling. I simply followed a rule that has served me well. Never invest in something you do not understand. And when you stop understanding something you own, sell it. Here is how I know when I have lost the ability to understand a business. First, when the source of profits becomes unclear in a good business, I can explain in simple terms how the company makes money. They sell products for more than they cost. They provide services that customers value. When I find myself unable to explain where profits come from, that is a warning sign. Second, when complexity increases without clear benefit. Some businesses naturally become more complex as they grow, but there is a difference between necessary complexity and complexity that obscures. When annual reports get longer and harder to understand, when new financial instruments appear in the footnotes, when business segments multiply and intercompany transactions become impossible to track, something is usually being hidden. Third, when my questions do not get clear answers, management should be able to explain their business in terms that an intelligent outsider can understand. When they cannot or will not, I become suspicious. Either the business is too complex for even management to understand, or they are deliberately obscuring something. Neither possibility is good for shareholders. Let me expand on this point about complexity, because it is so important. There is a certain type of executive who uses complexity as a weapon. They make their business deliberately hard to understand because confusion benefits them. If shareholders and analysts cannot figure out how money is being made, they cannot figure out when money is being lost or stolen. These executives hide behind jargon and technical language. They create Byzantine corporate structures with dozens of subsidiaries and related party transactions. They use accounting techniques that are technically legal but designed to confuse rather than inform. I learned to recognize these tactics through painful experience. A company I once owned had reported consistent profits for years. The business seemed to be doing well, but every time I tried to trace where those profits came from, I hit a wall of complexity. The money seemed to circulate between subsidiaries in ways I could not follow. When I finally forced myself to admit that I did not understand the business I sold, within 2 years the company collapsed in an accounting scandal. The profits I could not understand turned out not to exist. The complexity that confused me was designed to confuse. I escaped with most of my capital because I followed the rule. When you do not understand, do not own, the fifth and final red flag that makes me sell immediately is when the original thesis for buying no longer applies. Every investment I make is based on a thesis, a reason why this business will be worth more in the future than it is today. When that thesis is invalidated, the investment no longer makes sense, regardless of what has happened to the stock price. Let me give you a concrete example. Years ago, I invested in a company because they had a dominant position in a niche market. They controlled over 60% of this market, had strong relationships with customers, and faced minimal competition. My thesis was simple. This dominant position would allow them to raise prices gradually, expand their margins, and compound shareholder value for years. Then the market they dominated started shrinking. New technology made their product less necessary. Customers found alternatives. The market that had seemed stable for decades began contracting by 5 to 10% per year. My thesis was invalidated. Yes, they still had a dominant position, but dominating a shrinking market is very different from dominating a stable or growing market. The compounding I expected would not happen. The value I projected would not materialize. I sold even though I still liked the management team, even though the business was still profitable, even though the stock price had not yet reflected the changed circumstances. Here is the key insight about thesis invalidation. You must be honest with yourself about why you bought. Write down your thesis when you make an investment. Be specific about what must be true for the investment to work. Then periodically review whether those conditions still hold. It is easy to fool yourself. The human mind is remarkably good at rationalization. You bought a stock because of factor A, but factor A no longer applies. Rather than admit this and sell, you convince yourself that factor B is actually why you bought. And factor B still applies. This is how investors end up holding broken investments. They forget their original thesis or revise it unconsciously to match current circumstances. Do not fall into this trap. When your original thesis is invalidated, sell. You can always find another opportunity that makes sense today, rather than clinging to an idea that made sense in the past but no longer does. Let me tell you about a common form of thesis invalidation that catches many investors. You buy a stock because it is cheap. The company trades at a low multiple of earnings, a discount to book value, a fraction of what comparable companies trade for. Your thesis is simple. The market is undervaluing this company, and eventually the valuation gap will close. But then you learn why the company is cheap. Maybe the low valuation reflects real problems you did not understand. Maybe the business is in permanent decline. Maybe the competitive position is weaker than you realized. The thesis was based on the company being undervalued. But it turns out the company was appropriately valued or even overvalued given its true prospects. When this happens, you must sell. The fact that you already own the stock at a loss is irrelevant. The question is whether, knowing what you know now, you would buy at today's price. Here, if the answer says no, then holding is just as irrational as buying would be. Your purchase price is a historical fact with no bearing on future returns. Too many investors hold on to bad investments because they are waiting to break even. This is one of the most destructive habits in investing. The stock does not know or care what you paid for it. Your only concern should be whether the current price represents good value given the current facts. If it does not, sell and move on. I also want to address what I call the hope thesis. This is when your original thesis has clearly failed, but you create a new thesis based on hope. The company will turn around. New management will fix the problems. A competitor will acquire them at a premium. This hope thesis feels like investing, but it is actually gambling. You are not making a reasoned judgment about value. You are hoping for a rescue. I have never made money buying stocks based on hope. The rescues almost never come. The turnarounds almost never materialize. The acquisitions almost never happen. At the prices hopeful investors imagine when your original thesis fails, accept reality and move on. Now let me bring all 5 red flags together and share some broader lessons about selling that these experiences have taught me. The first lesson is that selling requires more discipline than buying. When you buy, you are acting on hope. You see a bright future and want to participate in it. This is emotionally easy. When you sell, especially when selling at a loss, you are admitting that your hope was misplaced. This is emotionally hard. Many investors fail, not because they cannot identify red flags, but because they cannot force themselves to act on what they see. The second lesson is that the time to sell is when you first identify the red flag, not after waiting to see if things improve. When I look back at my selling mistakes, they almost all have the same pattern. I saw the red flag, I waited, things got worse. I eventually sold at a much lower price than I could have gotten if I had acted immediately. The stocks that recovered after I saw red flags are so rare that I cannot recall specific examples. But the stocks that kept falling, those I remember vividly. The third lesson is that selling a stock does not mean you were wrong to buy it. Circumstances change. Businesses evolve. What was true when you bought may no longer be true today. Selling in response to changed circumstances is not admitting failure. It is adapting intelligently. The failure would be refusing to adapt, insisting that your original analysis must be correct, despite evidence to the contrary. The fourth lesson is that emotional attachment is the enemy of good selling decisions. When you have held a stock for years, when you have made money on it, when you have told friends about it, selling feels like betrayal. But stocks do not have feelings. Your loyalty does not affect their performance. The only question that matters is whether, knowing what you know today, you would buy this stock at this price. If the answer is no, you should sell regardless of your history with the investment. Let me share how I apply these lessons practically. Every quarter, I review each position in my portfolio and ask 5 questions. Has anything happened that impairs the competitive position? Has management done anything dishonest or that raises questions about their integrity? Has capital allocation become irrational? Do I still understand how this business makes money? Does my original thesis still apply? If any answer raises concerns, I dig deeper. If the concerns are confirmed, I sell. This systematic review prevents emotional attachment from clouding my judgment. It forces me to confront red flags I might otherwise rationalize away. I also keep a journal of my selling decisions. When I sell, I write down why. When a stock I sold continues falling, I review what I got right. When a stock I sold recovers, I review what I got wrong. This journal has taught me that my selling instincts are usually correct. When I see red flags and act on them, I am right far more often than I am wrong. The mistakes come when I see red flags and do not act, when I let hope override analysis. Here is the deeper truth about selling that I want to leave you with. Good selling is not about predicting the future. It is about recognizing when the present has changed. I cannot tell you whether a stock will go up or down next month. No one can. But I can tell you when a business has fundamentally deteriorated, when management has lost my trust, when capital is being allocated foolishly, when I no longer understand what I own, when my reasons for owning no longer apply. These are observable facts about the present, not predictions about the future, and acting on present facts is much more reliable than acting on future predictions. The 5 red flags I have shared today are permanent impairment of competitive position, management dishonesty, irrational capital allocation, loss of ability to understand the business, and invalidation of the original investment thesis. When I see any of these red flags, I sell immediately. Not because I am certain the stock will fall, but because the risk-reward has fundamentally shifted. The circumstances that made the investment attractive no longer exist. Holding on is no longer a rational bet on a bright future. It is an emotional attachment to a thesis that no longer applies. Develop your own framework for selling. Write down your thesis when you buy. Review it regularly. Be honest with yourself about red flags. And when you see them, act. The money you save by selling broken investments promptly will far exceed the gains you might miss by selling too early. That has been my experience over 80+ years of investing. And I am confident it will be yours as well.